You ever see this happen? A company puts out what looks like an amazing earnings report, and then you watch its stock just fall off a cliff? It's one of those classic market puzzles. And today, we've got a perfect case study, the engineering firm Stantec.
So that's the big question, right? How on earth does a company report strong growth, beat its earnings, and then raise its forecast for the whole year, only to have investors basically run for the hills? It just doesn't seem to make sense. But as we're about to find out, the devil is always in the details.
And I'm not exaggerating. This is what that reaction looked like. On August 14th, 2025, right after they released the results, Stantec stock just plummeted, dropping by as much as 10.3% in a single day. A really brutal response that left a lot of people scratching their heads. So to figure out why, first we have to appreciate just how good the good news actually was. I mean, on the surface, Stantec's Q2 report was pretty much a textbook example of a company that's firing on all cylinders. The headline numbers looked fantastic, suggesting a business with some serious momentum. Yeah, I mean, it's pretty much the perfect picture, right? They were growing sales, they were getting more profitable, and they were booking future work like crazy. Let's dig into what that actually looked like. First thing you see is the profits, a huge 21% jump in adjusted earnings per share compared to last year. And here's the key thing. That number, C1.36, was exactly what Wall Street analysts were expecting. So on that front, they absolutely hit the bullseye. And where was all that strength coming from? Well, take a look at their business. Their water segment is the biggest piece of the pie, about half their operations. And that part of the business was an absolute powerhouse this quarter, growing by a massive 12.4% organically. That's a huge deal because it shows their core business is incredibly healthy, pushed by these big global needs like fixing old infrastructure and treating water. And they weren't just growing, they were getting way more profitable while doing it. Their adjusted EBITDA margin grew by 120 basis points. Now, that's just a fancy Wall Street way of saying 1.2%. It's a crystal clear sign they're managing their costs really well, so more of every dollar they make is actually turning into profit. And the cherry on top? Management wasn't just happy with the last few months. They were so confident about what's coming next that they raised their predictions for the entire year on everything. More revenue, better margins, faster profit growth. So, with a report card this good, what on earth could have gone so wrong? Okay, let's play detective and figure this thing out. Because despite all those amazing headline numbers, Wall Street analysts and their trading algorithms basically ignored all of it and latched onto two very specific, tiny details. And here's clue number one. Even though Stantec's revenue was up a really healthy 6.9% for the year, it came in at $1.60 billion. The analysts were hoping for $1.64 billion. Now that's a miss of just 2.4%. To you and me, that sounds like a rounding error. But in a market that's priced for perfection, even a tiny crack like that can really spook people. All right, before we get to the second clue, let's just quickly nail this term down. When you hear organic growth, it just means growth from the company's main existing business, not from buying other companies. It's what investors watch to see if the core of the company is actually healthy and growing on its own. And here it is. This was the other shoe that dropped. Management ever so slightly tweaked their forecast for that organic growth, but specifically in the U.S. market. They explained that government projects were just moving a little slower than they thought. For Wall Street, any hint of a slowdown in your biggest market, well, that's a major red flag. So there you have it. Those two little details are what triggered the huge sell-off. But it really makes you wonder, was the market missing the forest for the trees here? Let's zoom out from the frantic minute-by-minute reaction and look at the actual long-term plan Stantec is building. See, while the market was obsessing over one quarter, Stantec was out making some serious strategic moves. They bought a company in Ireland to make their dominant water business even stronger. They expanded to New Zealand, and this is the big one. They closed a deal to buy Page, a 1,400-person firm in the U.S. that gives them a huge boost in red-hot areas like data centers and healthcare. And if you really want to understand their thinking, just listen to this quote from the CEO, Gord Johnston. He's basically laying it all out, saying, "Look, our business is right in the middle of some of the biggest, longest-lasting global trends of our lifetime." And these are exactly the trends he's talking about. We're not talking about fads that are going to disappear next quarter. The need to rebuild old roads and bridges, switch to new energy sources, manage water shortages, build tons of new data centers. These are projects that will take decades, and that's what's going to fuel Stantec's business for years and years to come. So what this really all comes down to is a classic clash in the investing world. You've got the market, which is obsessed with the next 3 months.
versus the company which is planning for the next 3 years and beyond.
And if you want to see the long-term side of the story, just look at this number, $7.9 billion. That's how big Stantec's contract backlog is. What that means is they already have about 12 full months of future work locked in, signed, and secured. That's incredible stability, something the short-term panic seems to be completely ignoring.
And maybe the most telling thing is this. In spite of any little hiccups right now, the company is executing so well that they now think they're going to hit their long-term profit goals a full year earlier than they had originally promised. That's a sign of a team that is absolutely crushing its own ambitious targets.
And so we end up right back where we started with this puzzle. The market saw a tiny revenue miss, a slight change in guidance, and reacted in a matter of minutes with a huge sell-off. But at the same time, the company is accelerating its long-term plan, riding these massive global trends. It leaves you with the ultimate question. Which one of those timelines is telling the real story?